Brad Williams, Frugal Finance. Hedge funds' uses of stock index futures. One particular hedge fund strategy is to establish a portfolio consisting of long positions in some stocks and short position in others, with no net exposure to market risk. The goal of the strategy is to make money from speculating on individual stocks with the portfolio without worrying about the direction of the overall market. Hedge funds employing this strategy are sometimes called long-short equity funds, equity market neutral funds, hedge equity funds, or relative value funds. One version of the strategy is referred to as pairs trading. The manager will position the portfolio to have approximately equal weights assigned to long and short equity position. Such a portfolio will be approximately market neutral, have a beta equal to 0, but typically the portfolio will exhibit some net market exposure. Long-short portfolio managers refer to this net market exposure as deadweights. The manager may use a stock index future contract, such as the S&P 500 futures contract, to establish a hedge to account for the remaining market exposure. As an example, consider a hedge fund that believes that investors are on the verge of reallocating the sector within their portfolios. In particular, the hedge fund manager believes that investors will rotate their investments from the pharmaceutical sector to the retail sector. The hedge fund manager believes that as the sector rotation occurs, retail stocks will rise relative to pharmaceuticals. In other words, the hedge fund manager believes that stocks in the retail sector are undervalued relative to the pharmaceutical sector. To take advantage of this belief, the hedge fund manager goes long retail stocks while simultaneously going short pharmaceutical stocks. Buyer beware. I'm just going to say, some of the smartest people on Wall Street tried to play this game. And one of the biggest disasters was pairs trading. Table 8.3 displays portfolio characteristics of the hedge fund under the long-short strategy. The weighted average beta of the pharmaceutical sector stocks within the portfolio is 0.39, with an aggregate value of $42 million. The negative sign reflects the fact that these stocks were sold short. The weighted average beta of the retail sector stocks with the portfolio is 1.07 with an aggregate value of $47.22 million. The net cash value of the portfolio, long position plus short position, is $5.14 million. The beta for the net value of the portfolio is 1.07 since the net amount results entirely from the outweighing of stocks in the retail sector where the weighted beta was 1.07. To make the portfolio market neutral, the hedge fund manager decides to establish a short position in the S&P 500, which are currently trading 1154. The manager uses equation 7.6 to determine the number of contracts to trade. 1.07, 5140, 1154 times 250 equals 19 contracts. Got that? So you got this pharmaceutical, and then we go retail. Purely hypothetical. So perhaps the next session, I'll tell you what the results are. Or maybe not. Brad Williams, Frugal Finance. Thanks for watching.